Okay, hi everyone. This is the online version of the continuation of our insurance lecture. I am going to go back over the introduction, but you can also feel free to watch the Zoom meeting from last week, which was March 18th at this point. So quickly just a recap on the background of insurance. So when we talk about the health economy, health insurance really underlies all of our discussions. Most Americans, really, and many other citizens of other countries, do not pay directly for their health care. Rather, private or public insurers pay for much of the care, with the consumer paying only a portion of the bill directly. Sometimes we call that portion coinsurance. Because insurance is so important to the demand and supply of healthcare, as well as the government's role in allocating health resources, we spent a little bit of time last week, we're going to spend tonight, and maybe even a portion of next week talking about the demand and supply of insurance in general and health insurance in particular. Now, this market is characterized by a great deal of uncertainty. I'm going to formalize these terms and talk about why that matters in the study of insurance. We are going to talk about uncertainty and the idea of risk, as well as attitudes towards risk. And then with those ideas in place, it will then be possible for us to consider the structure of insurance policies and how private markets, evolve to provide them. Ultimately, I hope we'll be able to answer the question, why aren't private insurance markets always efficient and/or fair? So again, just to recap, what is insurance? Well, just a very simple example to set up the discussion. You can imagine that you have a village or a room that has, let's take 100 people. And if each year we know that the risk of an adverse event, let's say becoming sick, is 1%, so 1 in 100 people will get sick this year, and that getting sick requires let's say $5,000 worth of spending. Now, any individual in the village or in our classroom may not be able to fork over $5,000 at any one point in time. So what everyone can do is chip in a little bit so that if one person gets sick, they can afford the $5,000 of spending. And this idea is fundamentally known as risk pooling. We went through this example last week, and we calculated that if there are 100 people, we would divide 5,000 by 100, which gives us $50 per person. And if every 100 persons in the village or the classroom chips in $50, we'll ultimately have a $5,000 pot for the person who ends up getting sick. In practice, how this works is there is a firm, so you can imagine that I'm going to go around and collect $50 from everyone in the classroom. So I'll collect the money. It'll be Kirsten Strombotny Insurance Company. And then I'll take all that money, maybe I'll try to maintain it and/or actually increase its value through investment, although this would have been a terrible time of history to do that, and then pay out the claims when asked. So that's kind of my role as the insurer. And we talked about last week that this principle operates on the law of large numbers in order to function well. That means we need a lot of people in the room in order to be able to make these predictions with any kind of I don't want to say certainty, but know how much money to collect and understand our risk well. I've linked, if you click on this slide deck on Blackboard, to this law of large numbers. It'll take you to the Khan Academy, where you can watch the Khan Academy do an actual video on how the law of large numbers works if you're interested in the math or the stats behind this. Okay, so the example that I just went through illustrates a few desirable characteristics of just a general insurance arrangements. So one, the number of insured people should be large, right? So 100, technically the law of large numbers kicks in around 50, I think, but we'd want to be up in the thousands to be really sure. And the number of insured should also be independently exposed to the potential loss. 2, the losses that are covered should be definite in time, in place, and in amount. So getting sick should be a one-time event that can be characterized by these elements. The chance of loss should be measurable. And also that loss should be accidental from the viewpoint of the person who is insured. I want to make a distinction between insurance and social insurance at this point in the lecture. So insurance can be, well, just generally, it's provided through markets where buyers protect themselves against rare events. So it has to be a rare event with the probability that can be estimated statistically. So all of these things have to happen for an insurance market to work. Now, government programs in particular use the government as insurer and are distinguished by 2 features. So one, the premiums or the amounts paid by the purchasers are heavily and often completely, as in the case of Medicaid, subsidized. And 2, participation is generally constrained according to government set eligibility rules. In addition, government insurance programs often transfer income from one segment of society to another. And, given the importance of social insurance programs, we're going to devote some time later in the course to them in particular, but I do want to mention that right now what we're doing is thinking about markets for insurance. So we're really thinking about private insurance. So last week we also went through some terminology. I'd recommend you go back to that lecture if you are confused about terms like in-network, out-of-network, deductibles, co-insurance, out-of-pocket payments, or even premiums. There's also some great resources online. And what I'm going to do in this lecture, and I'll do this at this point in the recording, is leave some places for you to quiz yourself and test your knowledge. So what I will recommend you do at this point in time is press pause on your video and just kind of try and work out some of these questions on your own. What we'll do when we meet this coming week on March, what is this going to be? March 25th, is we will go into smaller breakout rooms and discuss in smaller groups the answers to these questions. So go ahead and hit pause and see if you can work some of these questions out yourself. Okay. So I started off this course talking about ways in which healthcare markets deviate from an idealized market with perfect competition. We've talked a little bit about asymmetric information in that context. We use an example where when a patient goes to the doctor, she doesn't know the price of treatment she will receive, right? So in general, patients are often poorly informed compared to the provider about their conditions, about the treatments available, expected outcomes, and even prices charged by other providers. Today, I'm going to be talking again about asymmetric information, but in the context of insurance markets. So here, if you imagine that the supplier of insurance is the insurer and the demander or the consumer of the insurance is the patient or even the employer on behalf of the patient, that's how we're going to think of our market for health insurance. So why would we see asymmetric information in this particular market? Well, asymmetric information in general arises because a beneficiary, right, or the patient, has better information than the insurer about her own health status and expected demand for health care. And as a result of that better information, the premiums for the higher risk patients are going to be underpriced so that the higher risk patients tend to overinsure while the opposite holds for lower risk patients who tend to underinsure. And this will make more sense in a few slides. So consequently, consequently, it reduces the efficiency of the market. It's going to be key to understanding issues like uninsured or performance of PPOs and HMOs. Now, I'm going to talk about the lemons principle. The Nobel laureate George Akerlof, I think he got the Nobel in 1970, is often credited with introducing the idea of asymmetric information through an analysis of the used car market. Though it's, used car market is seemingly unrelated to healthcare, his classic article is important for a couple of reasons. First, it tells us a lot about adverse selection and the potential unraveling of health insurance markets. Adverse selection provides a key to our understanding of some major contemporary issues. Second, his example is going to lead right into the issue of agency, which will be a big topic for us when we talk about physician labor supply markets. Fun fact, George Akerlof is married to Janet Yellen, who was the chair of the Federal Reserve from 2014 to 2018. So I think that makes them the Kim and Kanye of economics. Sorry. Okay, so the example that Akerlof uses is the used car market, where the consumer has little or no information about the quality of the product, right, the quality of the car, and the seller, the used car salesman, knows the whole or partial history of the car. And this example is going to make many simplifying assumptions, right? It's a kind of a good example of the use of abstraction to make a point. That point is going to be that the asymmetry of information results in the market functioning poorly or actually in the extreme disappearance altogether. And in Akerlof's model, used cars are available for sale and they vary in quality from those that are still in mint condition, we'll call those peaches, to some that are just total lemons. And for those of you who've never heard the expression that a car is a lemon, it means that it looks fine on the outside, but actually it's got all sorts of problems under the hood. Things that you wouldn't know until you started driving it around for a while. So information asymmetry arises if, as is totally plausible, the sellers know better the true quality of their cars than do the potential buyers. And Akerlof shows that where such information asymmetry exists, it causes the market for used cars to perform poorly or even to disappear entirely. So I'm going to run through an example. You can imagine that I have a car and I am trying to sell my car to Yev. I know the true value of my car. I know if it's a peach or a lemon or just average, and Yev only has some idea. Now, if my car is a peach, right, so if it's in mint condition, Yev would value a car in mint condition at $5,000. I would value it, let's say, at $4,500. So if this information were known to Yev, would he buy the car? Think about that. Well, yeah, he should buy the car, right? If Yev values it at $5,000 and I value it at $4,500, then we both stand to gain by exchanging the car, right? Now, if the car is average, Yev values it at $2,500, and let's say I value it at $2,000. And if the car is a lemon, Yev doesn't want it. He values it at $0. It's going to be a money pit, and he'd rather not have it. And I don't know, maybe I value it at $100 because I have some sentimental attachment to it. So if this information were known to Yev, what would he do? Well, if he knew this information, if he knew the car was average, he would purchase it, right? $2,500 is more than what I value it. And if he knows it's a lemon, he definitely wouldn't purchase it, right? I value the car more than he does. Pretty basic. But Yev doesn't actually know what kind of car I'm trying to sell him. He can speculate, right? He can make a guess. How would he do that? Think on that for a second. Okay, this is probably one of those situations where I've already given you the answer on the slide. So if you want to challenge yourself, just go ahead and pause the video throughout when I ask questions, and you can try to work out for yourself how you would do this, but if not, carry on. So Yev would speculate that each possibility, so a peach, an average car, and a lemon, has equal probability. So 1/3, 1/3, and 1/3. So let's suppose that Yev offers a naive price. So under a naive bargaining strategy, it means that I'm assuming I'm always willing to sell to Yev and at most willing to offer his expected value. So there's nothing fancy going on in the way of game theory here. We're just using this to illustrate an example. So if Yev offers a naive price, how might he determine his offering price? You can think about that for a moment. Pause if you want to work that out. Well, he would use something called the expected value. And the expected value, if you've not used this concept before in your statistics class, is fairly straightforward. It's like a sum product in Excel. It's the sum of the probability of each option multiplied by the value of the option. So in this case, what we would do is, to find the expected value, we take the probability, let me see if I've got a marker here. The probability of a peach is 1/3. The probability of an average car is 1/3, and the probability of a lemon is 1/3. And you multiply that probability times the value if it's a peach, if it's average, and if it's a lemon. Now again, this is the expected value to Yev. So we look at peach, average, and lemon. And what's the expected value in this case? You can go ahead and calculate that out. It should come out to about 2,500. Okay? Now, let's say Yev is willing to offer me 2,500. Let's think about that case. What if the car is a peach? So he offers me 2,500. If he offers me 2,500, I need a price, I value a peach at 4,500, right? So Yev's naive offer, his expected value of 2,500, it's not enough, okay? So no transaction's gonna take place. But if no transaction takes place, Yev knows that a peach owner is not gonna accept his offer, right? So he wises up a bit, and at most, he's only willing to offer me the expected value of the remaining two options. He knows the car's not a peach, so now he's updating his info and he's saying, okay, it's got to be probably a 50% chance the car is average and a 50% chance the car is a lemon. So here, the expected value is going to be 50% times the value of an average car plus 50% times the value of a lemon, comes out to 1,250. Now, then what? If the car's a peach, I need 4,500 to sell. If the car's average, I needed 2,000. Yev's offer of 1,250 is insufficient here again. So only the lemon owner is still willing to sell, but Yev doesn't want to purchase the lemon, right? The presence of that lemon in the market means that no transactions are taking place. Now, is there a potential solution around this when we think about the car market? Pause and think if you can think of one. And there is something called Carfax, which basically is a history of a used car. You think about the analogous example in health insurance. Hopefully you're thinking of pre-existing conditions. So anyway, where we're going with this is that the health insurance market is basically like a mirror image of the, oh, now I have a laser pointer, of the used car market. Sorry, this is gonna get better as I practice recording lectures. Information asymmetry is likely gonna occur because the potential insurers know more about their expected health expenditures in the coming period than does the insurance company. How do I get this? Okay, here we go. So who's the used car salesman in the health insurance market and who's the car buyer? Well, icky comparison, but the used car salesman is basically the patient, right? You know more about the status of your body and your health condition. And the car buyer here is the insurer. And why is the market inefficient in the presence of asymmetric information? Well, because the patient's unable to purchase risk. We're going to see a little bit more about how that happens. Now, in sum, this is a problem facing competitive insurance markets, and it's adverse selection, right? It's a market imperfection where patients generally know more about their health status and can hide it from the insurer, right? So it means that those with the greater risk, so the kind of not the lemons, but the people who have more health needs are going to demand more coverage, while those at the lower risk may opt not to be insured at all, right? And what happens if only the high risk people are coming into the pool is that it has the effect of increasing the average risk of the people who are insured. So what happens, let's go back to our example where we had 100 people in the room, the 1 in 100 risk of getting insured. Well, what if some of the people in the class know they're never going to get sick, and some of the people in the class know they're definitely going to get sick? Well, the people who know they're definitely going to get sick are going to purchase health insurance, and the people who know they're definitely not going to get sick are not. So we're going to be left with a pool that's more likely to get sick. So it's going to be more expensive to cover those individuals, right? Risk is higher, pool is smaller. So as a result, the premiums rise, right? It means that there's two groups who could, basically be left uninsured. One, those with low risk who pull out of the market altogether. And then two, those with high risk who can't afford the premiums altogether. We talked a little bit last week about why single employee plans are cheaper per person than partner plans. And this is all to do with adverse selection, right? If one partner is in relatively good health, they can opt in to a high deductible plan with low monthly costs, right? Either in the private market or through a different insurer. So the fact that the spouse is opting into the low deductible plan with higher monthly premiums reveals something about whether the spouse is a peach or a lemon. And what I mean is, it says something about what the spouse expects to spend on medical care over the next year. So that's why you'd see them more than double for the partner plans. All right, again, this is a good place to stop and pause. Here are a few more questions to quiz yourself and see if you are grasping the information. Okay, and again, we will discuss those answers in class next week. So now that we've talked a little bit about asymmetric information as it pertains to the health insurance markets, let's talk about the role of risk and uncertainty. So at this point, we have all assumed that all of our decisions are occurring under conditions of certainty. That is, consumers know what the prices are, know incomes, tastes, and know what those things will be into the future. So clearly, however, many decisions are made under conditions in which the outcome is risky or uncertain. Now, I'll pause here and say that some of you may know from previous economics classes that economists sometimes contrast risk, where the probability of an adverse event is known, so something like the odds of a roulette wheel or the toss of a die. And they contrast that term with uncertainty, where the probability is not known, something like the odds of a nuclear plant meltdown. In my discussion today, I'm going to use those terms fairly interchangeably. Now, Let's talk about expected values. So we started off a little bit in our last section. Let's suppose I consider playing a coin flip game. If the coin comes up heads, I'll win $5. If it comes up tails, I'll lose $5. Okay. What is the expected value? Well, let's pause actually. How many people would take that bet? Think about it. I said if you could either win 5 or lose 5, would you do it? Well, we rely again on the concept of expected value for the answer. With an honest coin, the probability of heads is 1/2, as is the probability of tails. So the expected value, which is sometimes called the expected returns, is the probability of heads times the return of heads. So here, $5, times the probability of tails and the return of tails. So here it's a $5 loss. So we can calculate that out. You'd have 50% times the $5 win plus 50% times the $5 loss. And we'd come up with an expected value of this game of $0. So if we use the decision criterion that I will play the game if the expected return exceeds the expected cost, then I should be pretty ambivalent about playing, right? If I did it once, I might lose 5 or gain 5, but if I did it over and over and over again, law of large numbers, on average, I would expect the return to be nothing, and there's no cost to playing the game in the first place. There's a cost to losing and an upside to winning, but no price for pain. Now, what about this example? So in this example, if I toss heads, you win $125. If I toss tails, you lose 100. How many people would actually take that bet? I bet fewer of you would take that bet compared to how many said they would take the first bet. Why? Well, what's the expected value of this second game? We can do it in the same way. We take 50% probability of a win, so $125, plus 50% probability of a loss. And the expected value of this game is $12.50. Now remember, the last bet had an expected value of $0, right? But why does this bet feel worse, right? Even though the expected value is higher, there's a possibility that you could lose a lot of money, right? And we have attitudes towards that risk. So let's talk about that. Actually, one more thing I want to mention while we're on this game as an aside. Imagine if I told you there was a price to play this game in the first place, right? Like this special case where the price of the gamble is exactly $12.50, right? So it equals the expected return. That's analogous to an insurance situation in which the expected benefits paid out by the insurance company equal the premiums taken in. So if I tell you it costs $12.50 to participate in this bet, and the expected value is $12.50, the equality of that expected benefits payment and premium is called an actuarially fair insurance policy, right? In reality, insurance companies have to also cover additional administration and transaction costs to break even. We call those loading costs, but the definition of an actuarially fair policy provides a benchmark in talking about insurance. Okay, so let's go back to our original question. This bet has a higher expected value than the last one, but most people probably feel a little more uncomfortable with this bet. And why? Well, humans don't really think about expected value. So we don't do that expected value calculation in our head when we make decisions, right? We actually think about expected utility. So there's that word again popping up in our lecture. Now, expected utility operates fairly similarly to expected value, or I should say it's calculated in a similar way. And it's the probability of the gain, but rather than multiplying it by the value of the gain, you multiply it by the utility of a gain. And then you add it with the probability of a loss times the utility of the loss. So let me give you another setup. Imagine you have two choices. Choice A, I'll give you $70 right now, guaranteed. In another choice, another option, I'll give you a 70% chance of $100 and a 30% chance of $0. Okay, so let's go back to expected value for a second. What is the expected value, so not utility, but value of choice B? Think about that. You can pause here if you want to work it out. So the expected value of choice B is the probability of $100 plus the probability of $0. So 0.7 chance of 100 times 0.3 chance of 0. The expected value of choice B is $70. So choice A, 70, choice B, 70. They have the same expected value, but not everybody is ambivalent between choice A and choice B. Why not? Well, because people have different attitudes towards risk. Now, you could be risk averse, you could be risk loving, you could be risk neutral. Who do you think, or which option do you think the risk averse individual prefers? What about the risk loving individual? And the risk neutral individual? Well, the risk averse individual prefers the $70 guaranteed. The risk loving individual prefers the equivalent expected value with some risk added in, right? It's kind of built into the definition here. And the risk neutral individual is indifferent between the two choices. Right? We can actually measure how risk averse you are by how much extra I'd have to give to the expected value of the gamble to make you indifferent. So you could think about it this way. How risk averse you are is how much I'd have to up this $100 bet before you take the riskier choice or the choice with more uncertainty instead of the $70 guaranteed. Some people would do it if it was 110, 120, 200, etc. Now, why might someone be more risk averse to begin with? Now, we need to kind of dig back into the toolkit from the first part of our course. Remember the law of diminishing marginal utility? That law tells us that for most individuals, the additional value of money gets lower and lower as you add more money. So I don't know if any of you have ever heard this statement, or I don't know what you would call it, statement that basically anything you make over $75,000 per individual doesn't add that much more to your happiness, right? That's a similar idea here where the wealthier you get, wealth is still increasing your utility, but not as much as it is at the lower values of the wealth. So each additional dollar adds less and less utility. Now, let's see, we're going to go through an example to show why the law of diminishing marginal utility explains risk aversion. Okay, so let's assume that this function, so this curve is, I'm going to say this is a square root function. So if you can pop that into Google and see that if you looked at utility and income, that the square root would give you a curve that looks something like this. So we're going to calculate the utility for the gamble and calculate the expected value of the utility. So again, you can recall expected utility is the probability of the gain times the utility of the gain and so forth. Now, again, suppose utility is measured by the square root of your income. Now the expected utility of the gamble, so remember that was choice B, was a 70% chance of winning $100 and a 30% chance of winning nothing. So let's plug that in. Let's find out what is the utility of $100. Well, I've defined the function here. So the utility of $100 is the square root of $100. And the utility of $0 would be defined as the square root, right? So we're plugging them in to this equation here. Square root of 100 is what? 10. Square root of 0 is, yep, 0. So 0.7 times 10 is 7. And the utility, the expected utility of our gamble, so where we had a 70% chance of 100 and a 30% chance of 0, is 7. What's the expected utility, or what's the utility of $70 for sure? Well, it would be the square root of 70, which is about 8.4. So what do you see here is that the utility, if this is your kind of utility function of income, if it's diminishing marginal utility, the utility of a sure thing is higher than the utility of a uncertain thing, in very simple terms. So let's go back to our initial example. Let's say we've got a village with 100 people. Each year, we know that one person's going to get sick. They're going to require $5,000 worth of spending. How much should each person chip in to ensure that everyone can afford the $5,000 worth of spending? We said $50, but is it actually worth it to spend the $50? That was the expected value, but now we've brought in this concept of utility. Is it worth it to spend $50 to insure against a 1 in 100 chance of losing $5,000? This is the same thing basically as asking, should we buy insurance? Okay, so let's take an example. Let's say we have our hypothetical person, Sarah, here, and in this world, Sarah has a 50% chance of staying healthy and a 50% chance of getting sick. Now, if she's healthy, her income or her wealth will be $20,000. If she gets sick, her wealth is going to drop to $10,000, right? So it's important here to incorporate Sarah's utility of wealth function into the analysis, right? What would, let's move, bear with me, I'm going to move to a different screen to walk through this example. Bear with me. Let's do screen, broadcast. That should be coming up here. Okay, good. Here we go. Now, let's move into Notability. Okay. So, let's visualize this on a graph. So we had the example where we have wealth on our x-axis, we have utility on our y-axis, and Sarah had a utility of wealth function that looks something like this, which represents her utility with certainty. Now, recall that under normal circumstances, Sarah has a wealth of $20,000. And in the graph I showed you, when Sarah has $20,000, she has a utility of 200. Now, if Sarah gets sick, her wealth will drop to 10,000. In this case, she has a utility of 140. So if she's sick with a probability of 50%, she's healthy with a probability of 50%, can we calculate the expected wealth of this situation? Well, the expected wealth would be the probability, so 50% chance of having 20K. So remember, that's a situation in which she's healthy. And a 50% chance of having 10K. So 50% of 20,000, that's 10,000 plus 5,000 equals $15,000. So the expected wealth, Sarah's expected wealth in this situation is 15K. What about her expected utility? Probability of, so what was her utility at 10K? Remember it was, well, I'll do it in the way I initially did. When she's healthy, her expected utility, or her utility with certainty, was 200. And when she's ill, her utility with 10K was 140. 50% of 200 is 100, plus 50% of 140 is 70. So expected utility is 170. Now, let's plot that out over here. So expected wealth is about 15K. Let's assume that if you have 15K with certainty, your utility, I don't know, is 180, but your expected utility with $15,000 is about 170. So what this shows is that the uncertain nature of the outcome of that 15K actually puts Sarah at a lower utility than if she had 15K with certainty. We could actually draw a straight line here. Try changing colors. From this point to this point, it would pass through our example right here, where we could play this game. We could do this example over and over again, where I give you different weighted probabilities. So I say probability of being healthy is 0.75 and probability of being ill is 0.25, or we could do it again with, you know, 0.6 and 0.4. You get the point. And what this pink line would represent between these 2 points is the expected utility of all different possibilities of illness, all different probabilities. So this pink line between health with certainty and illness with certainty represents expected utility. So we had utility with certainty and expected utility. So what we see is the uncertainty in the gamble actually costs us utility, right? In this case, it costs us this utility. It costs us 10, right? So what would be an actuarially fair price for insurance? Think about that. So the actuarially fair premium would be about $5,000. right? You'd be willing to insure against loss. But actually, Sarah would be willing to pay even more to insure against the loss. And why is that? Well, you can think about, go back to green here. You can think that with uncertainty, expected utility is 15K, but that same level of utility, 170, you can have that with certainty for an even lower amount, right? So you're actually willing to pay even more to insure against the loss. So you're willing to pay this amount to insure against the loss because, sorry, you can't see this amount. You're willing to pay this amount to insure against the loss, right? Because having 15K with certainty means you've got a utility of 180, and having 15K with uncertainty, you have a lower utility. So having the insurance makes you better off because of the certainty, right? But if you're willing to pay, what in the world? If you're willing to pay 5K and accept 180, you may actually be willing to pay up to this distance here. And that's what the insurance company can charge you in loading costs and actually make a profit. Okay, so what does this analysis illustrate? Well, it shows that insurance can only be sold in circumstances where there is a diminishing marginal utility of wealth, right? That is, the consumer has to be risk averse, because if marginal utility were constant, so what would that look like? A diminishing marginal utility looks something like this. A constant marginal utility would have a utility curve like this. So that's equivalent to this straight line pink here, expected utility. If marginal utility is constant, paying an actuarially fair premium would actually leave you no better off than if you're insured, right? If you imagine that this blue, dark blue line doesn't exist, and that your utility with certainty is the same thing as this pink line, then paying to remove the uncertainty doesn't leave you any better off, right? So the second thing that this analysis illustrates is that the willingness to buy insurance is related to the distance between the utility curve, so this blue curve here, and the expected utility line, right? So you can think of it as like this chunk in the middle. So if you're very unlikely to become ill, so you're somewhere near here, then the expected utility is going to be almost identical to the certainty utility, right? In this area of the curve. And gains from insurance are going to be small. If you're relatively healthy, gains from insurance will be small. If your probability of illness is almost certain, so you're approaching somewhere over here, again, gains from buying insurance decrease. Why? Because here you're better off self-insuring by putting almost $10,000 away to pay for an almost certain illness, rather than incurring the trouble of buying insurance, filing the claims, paying the loading fees, etc. Something else to mention is that if insurance companies are charging more than the actuarially fair premium, but people have less wealth from insuring than not insuring, the increased well-being comes from the elimination of the risk, right? That is the whole purpose of the insurance market. The increased well-being comes from elimination of risk, right? In short, anyone with a probability of illness approaching 1, so anyone down here, is uninsurable. These are likely to be the elderly, the chronically ill, those with pre-existing conditions. And again, I'm talking about a market with no regulation, because the loss begins to approach the cost of the premiums and they're priced out, basically. Okay, so give me a moment. I'm going to switch back to my screen share. Continue. Okay. So how do insurers actually price these premiums? So the way I just showed you is a fairly simplified example, but in general, there's kind of 2 broad approaches that the insurer can take. The first is something called experience rating. So that's where the price of the premium basically reflects the dollar amount of claims submitted during the previous period of year, right? This takes into account your risk, right? Like your pre-existing condition, something like that. A community rating is an alternative approach where insurers pool risk over large groups, right? States basically have upper and lower limits on the prices insurance can charge, but the premium is based on the risk of the entire membership, right? Managed care organizations have become competitive basically by finding favorable groups to insure. They kind of like cherry pick folks. They do this on the basis of cost. And we could talk a little bit more about this in class on Wednesday night if anyone is interested in this topic. Experience rating. So the first option, this is where you base the premium based on identifiable personal characteristics, right? Doing this, what's the benefit? Well, you can kind of reduce the practice of adverse selection to some degree. It's kind of like having that Carfax personal history of the body, right? The disadvantages are, sometimes it's inequitable, right? Because people with pre-existing conditions find it very difficult to get insurance. And in this country, historically, insurance has been highly linked to access to care. Another disadvantage is that it encourages insurers to cherry pick healthier enrollees. They can do this in a number of different ways. I mean, Medicare Advantage will do this by advertise at health clubs or places where they know healthier or wealthier individuals will go. One thing to note is that individuals who are part of large employer-based groups are largely insulated from this practice. It has a bigger impact more in the private market, but those who purchase individually have traditionally been subject to very stringent underwriting. This would also kind of answer the question, like, why are premiums more expensive for tobacco users, right? This is a form of experience rating that's currently permissible under the ACA, and it's because it tells you a little bit about the history of health for that individual and their likelihood of needing healthcare in the coming years. So you can see this is my old health plan where you can see in any of these charges, individuals who have a history of smoking have higher monthly premiums. I'm gonna skip over some of this for the time being. Let's go to this portion. So here's another point in the lecture where you can pause and give yourself a little quiz. Again, we will talk about the answers in class next week. Okay, and why don't we actually stop here for the night, and we can go over a little bit more in class on Wednesday or push this off to the following week's lecture. So I look forward to seeing you all on webcam in the next few days, and please reach out if you have any questions. Thanks so much.